Hi, I'm Shawn Hyde, a business appraiser with over 25 years experience in my industry. Today, I want to talk about the market approach and specifically the Guideline private company transaction method. Now, the way this method works is we identify transactions of similar size businesses in a similar industry that transacted or that were sold, oftentimes across the country. Now, some folks will ask, hang on, why are you looking at across the country? Why not a specific geographic locale? For two reasons. One, businesses operate in a similar fashion regardless of where they're located. A hamburger joint in Missouri operates similar to a hamburger joint in Kansas or Alaska or Southern California. So the geography of a specific location is not as important in business appraisal. Now, what is important are the level of taxes that we could expect, and those have to be identified based on a geographical basis to identify the level of income the business is able to generate. Because there's two different levers we look at. There's the income the business is generating, revenue, EBITDA, SDE, seller discretion earnings, or what have you, and the magnitude of the multiple for the transaction. So we look at these transactions and we identify a number of them. We want to have at least 6, 7, 8, 9, 10 or so to have an idea of what the market would be. Too few and it's just not as reliable. Too many, and it gets cumbersome. We also want to make sure that there's going to be outliers. Some of these transactions include other assets. They may have sold real property. They may have sold some level of working capital or not. One thing is important to keep in mind is the underlying assumption for most of these databases is that the businesses that are sold as asset sales, meaning the assets that sold were the name, the client list, the staff trained in place, equipment, inventory, things like that. What was not sold is often working capital or any of the debts that business may have held were also not transitioned. So when we look at these transaction databases, we can look at what's the average multiple that these things transacted at, because there's going to be a range. Some businesses sell for lower multiples, some of them for higher. But to find out what multiple we should use for the valuation of the company that we're looking at, we need to rely on the industry comparative ratio analysis to try to decide, is the business that we're appraising, is it in line with the average of the overall businesses that have sold, of the industry average? If the business that we're appraising is stronger than the industry average, then maybe the multiple that we select should be on the upper end of that range. The opposite is also true. If the business that we're appraising is on the lower end, if it's higher risk, then maybe it would sell for a likely lower multiple. But anyway, when we do that analysis, we figure out what that multiple is we want to select and use. It's our choice as the appraiser based on the analysis of the facts. We also need to consider, are we doing an equity analysis for some other purpose? Are we doing a divorce or a partner buyout or dispute of some other kind of issue and not an asset analysis? Because if that's the case, we also need to make additional adjustments to that indicated value. You have the multiple, you derive an indication of value, its assumption is that's an asset sale. So add back the working capital or normal level of working capital, subtract out the level of inventory, the normal level of operating inventory, because that's already included in the multiple. But you also need to subtract out any debt the company may hold as of the valuation date. That's how you convert an asset transaction indication of value to an equity. If you have any other questions, feel free to comment on this video. We'd love to answer any other questions you might have. Take care.